This is a solar panel. It's a 400-watt monocrystalline module manufactured in Wuxi, China, installed on a rooftop in Munich, Germany. On a clear summer day, this panel generates enough electricity to power a small refrigerator for 24 hours. It represents everything Europe believes about its energy future: clean, renewable, independent, and free from the geopolitical leverage that fossil fuels create. Now here's the problem. It's January. The panel is covered in snow. The sun rises at 8:04 a.m. and sets at 4:52 p.m., providing less than 9 hours of weak winter light. Today, this panel will generate approximately 47 watt-hours, enough to charge a smartphone twice. Meanwhile, the apartment below it requires 28 kilowatt-hours to maintain heating, lighting, and basic appliances. The gap between what the panel provides and what the building needs is filled by natural gas, burning in a boiler in the basement, molecules that traveled thousands of kilometers from a source that Europe's energy strategy pretends no longer matters. On January 21, 2026, Russia's Ministry of Energy published its updated Arctic development timeline. By 2030, Russian Arctic gas production will reach 180 billion cubic meters annually, equivalent to half of Europe's total consumption. By 2035, it will reach 280 billion cubic meters. The gas will flow to China, India, and any European nation willing to buy it, at prices that renewable alternatives cannot match, through infrastructure that European sanctions have failed to prevent. Europe's energy strategy is not competing with Russia's Arctic expansion. Europe's energy strategy is watching Russia's Arctic expansion happen while hoping the transition completes before the consequences arrive. The consequences are arriving faster than the transition. Here's what they're not telling you. Europe's energy strategy, codified in the REPowerEU plan, the Fit for 55 package, and the European Green Deal, rests on a simple theory. Renewable energy will replace fossil fuels, electrification will replace combustion, and efficiency will reduce demand. The strategy assumes that by 2030, Europe will have reduced gas consumption by 30%, increased renewable generation by 150%, and achieved sufficient energy independence that Russian supply decisions become irrelevant. The strategy is behind schedule on every metric. Gas consumption reduction has reached 18% against a 30% target. The reduction came primarily from demand destruction, closed factories, reduced industrial output, and households lowering thermostats, rather than structural transformation. When industrial activity recovers, so will gas demand. The reduction is partially reversible. The strategy assumed it would be permanent. Renewable generation has increased by 87 gigawatts since 2022. Impressive in absolute terms, but only 58% of the trajectory required to meet 2030 targets. Grid infrastructure has not kept pace with generation build-out, creating curtailment problems where renewable electricity is generated but cannot be transmitted to where it's needed. Storage capacity, essential for managing intermittent renewable supply, has reached only 12% of required levels. Energy independence has improved on paper, but deteriorated in practice. Direct Russian gas imports have fallen 90%, but LNG imports from global markets have risen to fill the gap, creating new dependencies on suppliers who sell to whoever pays the most. Europe is no longer dependent on Russia specifically. It's dependent on a global market where Russia's Arctic expansion will increasingly set marginal prices. At 7:30 a.m. Brussels time, on January 15, 2026, the European Commission's Directorate General for Energy circulated an internal assessment titled REPowerEU Implementation Status, Q4 2025 Review. The assessment has not been published, but portions leaked to Euractiv show the conclusion. Current trajectories are inconsistent with 2030 objectives. Significant acceleration is required across all pillars to avoid strategic energy vulnerability persisting through 2035. 2035 is the year Russian Arctic production reaches full capacity. The assessment is saying that Europe's vulnerability will persist exactly until Russia's alternative supply peaks. The timing is not coincidental. It's the core problem. This is where the lie becomes unsustainable. Europe's energy transition is racing against Russian Arctic development, and Russia is winning the race. The transition requires building infrastructure, wind turbines, solar farms, grid connections, storage facilities, electrolyzer plants for green hydrogen, and charging networks for electric vehicles. Each component requires permitting, financing, construction, and commissioning. The fastest projects take 3 to 5 years from approval to operation. Complex projects take 7 to 10 years. Russian Arctic development operates on similar timelines but started earlier and faces fewer constraints. Yamal LNG began production in 2017. Arctic LNG 2 began production in 2025. Arctic LNG 3 broke ground in 2025, with projected completion in 2029. The Vostok oil project, focused on Arctic crude but including associated gas, is on track for 2028 production. Each project adds capacity that will be operational while Europe is still building the alternatives meant to make that capacity irrelevant. The financial dynamics compound the timing disadvantage. Russia's Arctic projects are financed through state investment, Chinese development banks, and revenue from existing production. The financing is patient, returns are measured in decades, and political rather than commercial logic drives allocation. Europe's transition is financed through private capital markets that demand returns within years, not decades. Projects that don't meet commercial thresholds don't get built, regardless of strategic importance. On January 18, 2026, the European Investment Bank released its annual energy lending report. Transition-related lending reached €47 billion in 2025, a record. But the report noted that project pipeline constraints, permitting delays, and grid connection backlogs had prevented €31 billion in additional lending that would have been approved if bankable projects existed. The money is available, the projects are not. Russia faces no equivalent constraint. The projects exist because the state decided they would exist. The financing follows the decision rather than the decision following the financing. When institutions do this, they're not managing risk, they're containing disaster. The competitive dynamics between European transition and Russian expansion create a structural disadvantage that policy has not addressed. Natural gas is not merely an energy source, it's a price benchmark. Electricity prices across Europe are set by the marginal generation source, which during peak demand is typically gas-fired power plants. When gas prices rise, electricity prices rise, regardless of how much renewable generation exists. A grid that is 60% renewable still prices electricity based on the 40% that isn't. This pricing mechanism means that Russian Arctic gas affects European energy costs, even if Europe never imports a single molecule. As Russian production expands, it influences global LNG prices. Europe imports LNG. LNG prices affect European gas costs. European gas costs affect European electricity costs. The transmission is indirect but unavoidable. Russia's cost structure creates additional pressure. Arctic gas production costs approximately $3 to $4 per million BTU at the wellhead, among the lowest in the world due to giant field-scale, state-subsidized infrastructure and minimal royalty burden. European alternatives cannot match this cost. Norwegian gas costs $5 to $6 per million BTU. US LNG delivered to Europe costs $8 to $10. Green hydrogen, the theoretical future replacement, costs $15 to $25. Qatari LNG costs $6 to $8. At 2:15 p.m. London time on January 20th, the Oxford Institute for Energy Studies published an analysis of long-term European gas price scenarios. The central scenario showed European wholesale gas prices stabilizing at 35 to 45 euros per megawatt hour through 2035, approximately 3 times pre-crisis levels, and above the threshold at which energy-intensive industry remains competitive. The analysis noted that Russian Arctic supply growth represents the primary uncertainty. Higher growth scenarios correlate with lower global prices, but reduced European market share and influence. The trap is visible in that sentence. Russian expansion could lower global prices, which sounds beneficial, but would do so by capturing market share that reduces European leverage and extends dependency on a market Russia increasingly dominates. Less than 4 years remain until 2030, the target date for Europe's strategic milestones. Current trajectories miss those milestones by margins that cannot be closed through incremental acceleration. The gap between strategy and reality will persist through the period when Russian Arctic production reaches full capacity, creating exactly the vulnerability the strategy was designed to prevent. While one side plans, the other side builds. Russia's Arctic strategy is not merely about production volume, it's about market structure. The infrastructure being built creates customer relationships, pricing mechanisms, and supply chain dependencies that will persist for decades. The Power of Siberia 2 pipeline, now under construction, will deliver 50 billion cubic meters annually to China under a 30-year contract. The pricing is indexed to Chinese benchmarks rather than European spot markets, meaning the contract operates in a price universe that European mechanisms cannot influence. Similar long-term arrangements are being negotiated with India, covering both pipeline and LNG delivery. The Northern Sea Route infrastructure, icebreakers, ports, navigation systems, creates a logistics corridor that will serve Russian exports regardless of European market conditions. Ships that load at Yamal or Utrenia can reach Asia faster than they can reach Europe, at lower cost, without transiting any choke point that hostile powers control. The infrastructure inverts the geography that once made Europe Russia's natural market. On January 16, 2026, the Shanghai Petroleum and Natural Gas Exchange launched a yuan-denominated LNG futures contract with specifications matching Russian Arctic production grades. The contract enables Asian buyers to hedge Russian supply in their own currency, without dollar exposure, through financial infrastructure that Western sanctions cannot reach. The exchange reported first-day trading volume equivalent to 2.4 million tons, modest by global standards but significant as proof of concept. The financial infrastructure matters as much as the physical infrastructure. A market that operates in yuan, settles through Chinese banks, and prices based on Asian demand creates a parallel system that competes with the dollar-denominated European benchmark system that has defined global gas trade. Europe is not merely competing for molecules, it's competing for market architecture. China's role in Russia's Arctic expansion extends beyond purchasing. Chinese companies provide equipment that sanctions have denied from Western suppliers. Chinese banks provide financing that Western capital markets have closed. Chinese shipping companies are building ice-class vessels that will carry Arctic cargoes. The partnership is comprehensive, creating supply chain resilience that reduces Russian vulnerability to any future Western pressure. By 2030, the Sino-Russian energy corridor will handle more volume than European imports ever reached at their peak. The customer base that Europe abandoned has been permanently replaced by customers with deeper pockets, faster-growing demand, and no interest in conditioning purchases on political behavior. The mathematics of the trap are now inescapable. Europe's energy strategy faces a fundamental arithmetic problem. The transition costs more than continued fossil fuel use, takes longer to implement than vulnerability can be tolerated, and competes against an adversary that faces none of these constraints. Cost comparison. Europe has committed approximately 800 billion euros to energy transition through 2030, including public investment, private financing, and consumer cost absorption. The investment will deliver an energy system that remains dependent on gas for 40 to 50% of heating and 20 to 30% of electricity generation. Russia has committed approximately 150 billion euros to Arctic development over the same period, less than 1/5 of Europe's spending, and will achieve production capacity that influences global markets, regardless of European purchasing decisions. Timeline comparison. Europe's transition will reach meaningful completion no earlier than 2040 under optimistic assumptions, 2045-2050 under realistic ones. Russia's Arctic expansion reaches full capacity by 2035. The gap means a full decade during which Europe remains vulnerable to a supply system it cannot influence. Constraint comparison. Europe's transition requires democratic consensus, regulatory compliance, environmental review, and market-based financing. Russia's expansion requires state decision and state financing. The constraint asymmetry means Russia can respond to changing conditions faster, redirect resources more easily, and accept losses that market-oriented systems cannot sustain. The arithmetic produces a conclusion that European policymakers have not acknowledged. The transition will not complete before vulnerability peaks. The strategy that was supposed to eliminate Russian leverage will instead coexist with maximum Russian Arctic capacity for at least a decade. This is what a system looks like when the race was lost before the starting gun fired. The informed are not waiting for official announcements to understand what's happening. European utility stocks have underperformed global energy indices by 23% since January 2024, reflecting investor assessment that transition costs will compress margins without delivering competitive advantage. The market is pricing in a transition that burdens European companies without positioning them to win against lower-cost competitors. Natural gas futures curves show European prices remaining above 30 euros per megawatt-hour through 2032, 3 times pre-crisis levels maintained for a full decade. The forward curve contradicts political projections of price normalization, representing traded commitments by market participants with actual capital at risk. Industrial electricity contracts for 2028-2030 delivery show German prices 65% above French prices, reflecting nuclear versus gas generation mix differences. The spread indicates corporate assessment that German transition choices have created permanent competitive disadvantage relative to nuclear-powered neighbors. Capital expenditure announcements by European industrial companies show investment shifting to non-European locations at accelerating rates. BASF's Louisiana expansion, Volkswagen's North American battery plants, ArcelorMittal's Texas operations. Each announcement represents permanent capacity removal from European energy markets. The investment flows reveal corporate conclusions that public statements don't express. Physical gold purchases by European institutions have increased 18% year over year, with the largest increases among corporate treasuries and pension funds. The purchases reflect hedging against scenarios where energy costs destabilize currencies that corporate planning assumes will remain stable. The spread between paper energy contracts and physical delivery commitments has widened to 4.2% on European exchanges, indicating that parties with actual energy needs are paying premiums for guaranteed supply rather than trusting market mechanisms to deliver when delivery matters. The question is not whether Europe's energy strategy can survive Russia's Arctic expansion. The question is what survive means, whether it means achieving the goals the strategy promised or merely persisting through conditions the strategy was supposed to prevent. A solar panel covered in snow, 47 watt-hours against 28 kilowatt-hours needed, a gap filled by gas that flows from sources Europe cannot control, at prices Europe cannot set, through infrastructure Europe cannot influence. This is not an energy transition. This is an energy aspiration, a plan that assumes its own completion while the world builds alternatives that will outlast its timeline. Physics doesn't negotiate. Winter doesn't wait for grid connections. And reality, eventually, asserts itself over every strategy that assumed the future would arrive before the present became untenable. The divergence between Europe's transition timeline and Russia's expansion timeline is now measurable in years. What happens next is not prediction, it's arithmetic. 180 billion cubic meters by 2030, 280 billion by 2035, flowing to customers who never asked whether Europe approved.